2.3. Can the accounts be trusted? It is a matter of great moment to the analyst that the facts be fairly presented, and this means that he must be highly critical of accounting methods. Benjamin Graham and David Dodd. In financial statement analysis, we use the financial statements, along with other sources of information, to help us gain insights into the economic and business realities of a firm. However, before we start doing this, we need to consider whether there are any aspects of a firm's financial statements that might not be helpful to us. We will consider whether there are significant aspects of a firm that its financial statements might leave out altogether. We'll also consider whether there might be some significant aspects of a firm's financial statements that may be more confusing than enlightening. There may be aspects where management has considerable flexibility in the accounting treatments it can use, and so may have some scope to manipulate the figures to present the firm more favourably. There may also be aspects where management has little or no flexibility, and so may not be able to apply an accounting treatment most relevant to the situation of their firm. What the accounts leave out. The financial statements are a mixture of words and numbers, but they are mainly numbers. The financial statements are an abstraction of reality, a simplification of all the complex and varied things happening in a business. This means that the financial statements will invariably leave out a great deal. Some of the key aspects of a business that the financial statements leave out are its ability to generate positive net present value, NPV investments in the future, and the opportunity cost of its activities, or in other words, the cost of capital. If you read the financial statements of Ryman Healthcare and look for these two aspects of its business, you will not find them. They are not there. The shares in Ryman Healthcare trade on the New Zealand Stock Exchange. In recent years, investors have bought and sold these shares at over 3 times the book value of its shareholders' equity. What these investors are saying is that they think Ryman Healthcare is worth more than 3 times the value the company's financial statements say it is worth. Put another way, these investments are saying they think less than 1/3 of the value of Ryman Healthcare is included in its financial statements. These investors may or may not be right in their assessments. One thing we will learn in this study guide is that value depends on assessments of an uncertain future. So there is always scope for disagreement and for us to be proved wrong in our assessments by subsequent unexpected or unforeseen events. However, if these investors are correct in their assessments of the value of Ryman Healthcare, then its financial statements leave out more than 2/3 of its value. Does this mean that if we just look at the financial statements of Ryman Healthcare, we will leave out a lot of the value of this firm because it would simply not be included in the financial statements? Well, yes and no. Ryman Healthcare has a proven ability to consistently deliver positive NPV investments, and there are substantial grounds to consider it can continue to do this for many years to come. The omission of this capability of Ryman Healthcare in its financial statements is a major reason for the difference between the book value of the equity of Ryman Healthcare in its financial statements and the views held by many investors about its value. Another major reason for this difference is that Ryman Healthcare also has the capacity to earn considerably more than its cost of capital on the shareholders' equity invested in its existing activities. Ryman Healthcare delivered comprehensive income of $638.7 million in the year ended 31 March 2021 to provide a return on equity, ROE, of 24.9%. If you can consistently earn a return on equity of about 24.9% each year, you will become wealthy. At that rate of return, you will more than double your money about every 3 years. In other words, turn $1 into about $2 every 3 years. My 28-year-old son's shares in Ryman Healthcare are currently valued at about $150,000. If he was able to consistently earn 24.9% per year on his money, in 3 years' time, when he is 31 years old and perhaps buying a house and settling down, his $150,000 share portfolio would be worth about $300,000. When he's 34 years old and perhaps starting to have a young family, his share portfolio would be worth about $600,000. At 37, $1.2 million. At 40, $2.4 million. At 43, $4.8 million. At 46 years of age, $9.6 million. And at 49 years of age, $19.2 million. I think you get my point. The lack of many 49-year-olds with about $20 million in shares is probably enough testimony to how difficult it is to consistently earn returns of 24.9% per year. Suffice it to say, a return on equity of 24.9% per year, which Ryman Healthcare delivered to its shareholders in 2021, is a good rate of return and well in excess of the cost of that capital, which we later measure in Chapter 6, Section 6.2. If you thought Ryman Healthcare would be likely to deliver a return on its existing equity in the future greater than the cost of the capital it is using to generate this return, this would be a further reason for valuing Ryman Healthcare at greater than its book value. A large part of the value of Ryman Healthcare omitted from its financial statements is its ability to generate positive net present value (NPV) investments in the future through developing new retirement villages and extending existing ones, and its ability in the future to generate returns significantly greater than the cost of the capital invested in its existing activities, that is, the book value of its current shareholders' equity. The strategic choices of management greatly influence whether a firm will, in future, be able to make positive NPV investments into new assets, and in future generate returns higher than its cost of capital on existing assets of its business. We need to assess a firm's strategy to help us identify the key aspects of value a firm's financial statements might leave out. Indeed, the essence of financial statement analysis is converting qualitative assessments of a firm's strategy into quantitative assessments of value. Yet we do not only need to be sensitive to what significant aspects of value a firm's financial statements might leave out. We also need to consider whether there are significant aspects of value its financial statements do include, but in a way which might confuse rather than enlighten us. What the accounts confuse. The devil can cite scripture for his own purpose. William Shakespeare, The Merchant of Venice. Before we start analysing a firm's financial statements, we need to stand back and think about whether we have any reason to suspect some aspects of the financial statements may not accurately reflect the underlying economic and business realities of a firm. We look for aspects of the financial statements that might potentially confuse us rather than enlighten us about the realities facing a firm. What sort of things do we need to look for? First, we need to be clear that the financial statements are constructed by intentional human beings, that is, by management and accountants, and are not themselves the firm's economic and business reality. However, management generally have a good knowledge of their businesses, and certainly better than us as outsiders. After all, management are working full-time in the business. We are not. Management and accountants have the role to make judgments about how best to reflect the realities of a firm in its financial statements. However, management do not have carte blanche to present the financial statements of their business any way they like. They do not start with a blank sheet of paper. There are various accounting standards and generally accepted accounting principles and conventions that place restrictions on how management can construct a firm's accounts. This is the case in Australia, New Zealand and many other countries in the world. This includes various legislation which particularly affects firms that are companies or government bodies, the Australian Securities and Investments Commission in Australia, the New Zealand Securities Commission in New Zealand, the Financial Services Authority in the UK, and the regulatory bodies in a range of other countries, which regulate various aspects of the operation of capital markets in their country. The Australian Securities Exchange, the New Zealand Stock Exchange, the London Stock Exchange, and many other stock exchanges, which require certain disclosures to be made by firms listed on their exchanges, as well as the accounting standards and generally accepted accounting principles. Australia, New Zealand, UK and many other countries have adopted International Financial Reporting Standards, IFRS, for listed companies. Australia and New Zealand have also adopted IFRS for unlisted companies. This means that the accounting standards of Australia, New Zealand and the UK will be largely consistent with each other and with those of other countries adopting IFRS, such as the European Union, Russia, South Africa and many other countries, although there can be some differences between each country. Accounting standards help to create an accounting language as a standard way of presenting a firm's economic and business realities in the financial statements. But businesses are all different. They each have unique economic and business realities. No two businesses are identical. For example, Ryman Healthcare could be compared to the Zig-In Group in Australia. Both companies develop and manage retirement villages. Yet they also have many differences. For example, they have different business models. Ryman Healthcare sells long-term occupation rights to its retirement units, which customers purchase by way of providing Ryman Healthcare with interest-free loans. In this way, Ryman Healthcare retains legal ownership of its retirement villages. Zig-In Group sells its retirement village units to owner-occupiers. It is not possible nor desirable to have detailed accounting standards and rules to cover every conceivable situation that might occur in business. Considerable judgments need to be left to management and accountants to decide how best to reflect the realities of a firm in its financial statements. The IFRS reflect an appreciation of the need and desirability for these judgments. Management and accountants have an ethical responsibility to ensure they exercise these judgments in a way that results in the financial statements better reflecting the economic and business realities of a firm. However, the ability of management and accountants to exercise judgment and discretion in choosing some of the accounting treatments does introduce a level of uncertainty for the users of financial statements. In Australia, New Zealand, UK and in many other countries, listed companies are required to have their financial statements audited. External auditing of financial statements seeks to ensure management and accountants use accounting standards and conventions consistently over time and that their accounting estimates are reasonable. Nevertheless, the bottom line is that financial statements are constructed by management and accountants, and particularly under IFRS, they have considerable flexibility to make their own judgments about how best to do this. 2.4. Accrual accounting. Firms can last many years. For example, BHP Group has a market capitalisation of over $200 billion and is listed on the Australian Securities Exchange, with secondary listings in Germany, Frankfurt and Switzerland, Zurich, and its American depository receipts, ADRs, are traded on the New York Stock Exchange. It can trace its history to 1885 when BHP started a silver, lead and zinc mine in Broken Hill, New South Wales, Australia. Firms report periodically on their performance. We do not want to wait until a firm completes its lifespan before we find out how it is performing. In the case of some firms, like BHP, that corporate lifespan might be very long indeed, longer than we as individual equity investors could expect to live. Various stakeholders want to know what is happening in a firm at regular intervals during its life. To do this, financial statements are prepared using accrual rather than cash accounting. Accrual accounting requires the matching of expected costs and benefits of economic activities in a period, regardless of whether there has been actual receipt or payment of cash. Cash is a hard concept. You either have the cash in your pocket from or have handed over cash to another party, or you have not. There is not too much you can argue about that. On the other hand, accrual accounting requires an assessment of the economic consequences of current business activity, which will necessarily rely on several assumptions and be subjective. Indeed, this assessment of the economic consequences may be wrong, either deliberately or unknowingly. Reveal or disguise reality. Do financial statements, which are based on accrual accounting, reveal or disguise the economic and business realities of a firm? The answer is they can do both. Financial statements are an important means by which managers can communicate the realities of their firm to outside parties. But managers and accountants might be tempted to manipulate the perceptions of outside parties about the economic and business realities of their firm. They have considerable discretion on how they can use financial statements to reflect these realities. For this reason, we need to be sensitive to the accounting treatments used. The key attitude here is to be cautious and critical of the firm's significant accounting treatments. Listed companies in Australia, New Zealand, and in many other countries are required to make their financial statements widely available. We can usually obtain the financial statements of listed companies by going to their individual company websites, which will typically provide the company's financial statements. We need no market power to get this information from a company, just access to a computer. Regulations in each country require listed companies to provide financial statements, and the regulations are enforced, so companies generally comply. If we have the power to require disclosure, considerable information on private firms can also be obtained. This power would typically come from the firm's interest in entering negotiations with us about us potentially making equity or debt investments in the firm. The steady growth in private equity markets in Australia, New Zealand, and in many other countries has increased the extent of this activity. Also, suppliers and customers can sometimes have the power to require disclosures from private firms. As disclosure by listed companies is driven primarily by regulation, the various rules governing this disclosure greatly influence the nature of the reporting of listed companies by way of their financial statements. As disclosure by private firms is largely driven by the market power of the users of the information and is not generally made available to the public, there are few rules governing the nature of the disclosure, and the process of disclosure of financial and other information is more flexible. Once we have obtained financial information from a firm, the second step in financial statement analysis is not to analyse what the financial statements are saying, but to step back and assess the accounting treatments that are being used. We need to ask ourselves, how appropriate are the accounting choices and estimates the company's management are using in preparing the financial statements? There are two things to look out for. Remembering that the financial statements are put together by management and accountants, we need to consider those accounting policies and estimates of the firm where management and accountants have considerable flexibility under the accounting standards and conventions, and where the exercise of this discretion could significantly impact the financial statements of the firm. Also, the accounting standards may in other areas give management and accountants little or no flexibility to adapt the accounting treatments in the financial statements to the specific economic and business realities relevant to the firm, and so for this reason the accounts may not reflect well the underlying realities of a firm. Accounting choices of Ryman Healthcare. Let us think about areas where the management of Ryman Healthcare has some flexibility under the accounting standards and conventions, and where the exercise of this discretion could significantly affect its financial statements. One area where the management of Ryman Healthcare has flexibility is in selecting the basis for revaluation of properties. A key area of judgment for Ryman Healthcare is in the valuation of properties. Management would brief its independent valuers on the criteria or assumptions the valuer is to make when valuing the properties. Management would have the ability to exercise considerable discretion and judgment in how it does this. For example, it appears the valuations of the properties are greatly influenced by the level of residential property prices in the areas surrounding each retirement village. An alternative valuation basis for Ryman Healthcare's properties could be their value as a single portfolio of properties, for example, assuming they were syndicated to the institutional market and sold on yields related to commercial property. Depending on the valuation basis used, a wide range of values of Ryman Healthcare's properties would be possible. The revaluation of Ryman Healthcare's properties typically represents a significant part of its earnings and is a key driver of its value. Its headline earnings figure, profit for the year, in its income statement includes fair value movement of investment properties, but does not include revaluation of property, plant and equipment unrealised, which is included in other comprehensive income. This affects public measures of its price to earnings, PE multiples, published in the financial media and by financial information providers. Areas where management can typically have significant flexibility in applying their judgment to a firm's accounting treatments are, in general, level of allowance for doubtful debts, selection of depreciation rates, recognition of revenue, basis for revaluation of properties. It is important to remember the accounting treatment used needs to potentially have a significant impact on a firm's financial statements. Otherwise, it is not worth exploring. For example, although under the accounting standards, Ryman Healthcare has significant flexibility in relation to selection of its depreciation and amortization rates, accounting treatments in respect to this item would be unlikely to have a significant impact on its financial statements, as its depreciation and amortization expenses are relatively minor, about $32 million in 2021, mainly because it does not depreciate investment properties, the major part of its non-current assets. It is wise to be sensitive to the potential impact a firm's accounting treatments could have on how well its financial statements are likely to reflect the firm's economic and business realities. We need to develop a capacity to minimize or mitigate limitations in the quality of the financial statements to clearly represent the reality we are interested in understanding. Conclusion. We have seen in this chapter that a firm adds value by taking capital from investors and using it to earn a return greater than the cost of the capital it uses. To do this, a firm needs to generate returns to equity investors greater than the return required by capital markets generally in making equity investments, given an assessment by those markets of the risks the business is taking to generate those returns. We also saw that we are interested in a firm's future earnings because that is the journey we would take if we invest in shares in a firm. And a firm's future earnings will depend on the quality of its strategy and how well it is implemented. For this reason, we start financial statement analysis with a qualitative assessment of a firm's strategy. As we will be using earnings and other elements from the financial statements to capture in numbers, that is, quantify the strategy of a firm, we need to be sensitive to how well the financial statements may be capturing the realities of a firm. We need to understand what is left out of the accounts and what may be confused in the accounts. Indeed, are there aspects to the way the accounts are put together that may be disconnecting us from reality? Once we have first considered the firm's strategy and its accounting treatments, we are ready to consider how to assess the value of a firm using its financial statements. In the next chapter, we will see there are a range of methods and approaches analysts can use to assess the value of firms, some involving the need to make explicit forecasts about the uncertain future and others that do not. They can all have a place in helping us use accounting numbers to engage with the economic and business realities of a firm.